This market is now more retail driven than any market that we have seen in decades. I think we're going to take out $50 for the first time in silver's history, and we're probably going to keep moving higher. Let's go to 75 or 100. You've got half your investment in this AI space. We all cannot really escape it. We have to watch where this is going to go and whether or not we're going to get that bubble peak, because we're all going to feel it. The momentum is precious metals and AI stocks. So they probably will continue to be the best performers. I hate to say it until they don't. And when they don't, you'll know it.
There's a thesis out there that the American economy is running on AI sectors, boosting capital expenditure spending, boosting the S&P 500 overall. And without the sector, everything would slow down. We'll examine this thesis today and what to do with our investments during this time with market valuations the way they are, with Jim Bianco, our guest today. He is the president and founder of Bianco Research. Welcome back to the show, Jim. Always good to see you. Thanks for being here.
Thanks for having me. Looking forward to the conversation.
Yeah, looking forward to it as always. Let me start with a tweet that you've been making, or I guess it's called X. I don't know what's the verb? You X'd it? Anyway, so you went on X. The AI boom bubble now has the S&P 500 and the NASDAQ 100. With the same 8 larger stocks, these two indices are merging into the same thing. Yes, we know this is a concentration bubble. Is there a valuations bubble?
Yes, and yes, there is a concentration bubble that, the top 8 stocks in both indices are the same. You could see that it's 37% of the S&P and it's nearly 70% of the NASDAQ 100, so their correlations will be higher. Is there a valuation bubble too? I would argue yes, or at the very least, these stocks are extremely overvalued. Now, here's the problem. It's not that these stocks have particularly high valuation, but I'll point out what people like Roger McNamee of Elevation Partners, Sam Altman of OpenAI have recently said. Not everybody can win. And what the market is doing is similar to what we saw in the late 1999, early 2000 period, is that back then, if you stuck .com on the name of your company, it soared in valuation. Well, not every .com can win. We found that out with famously Pets.com, which is kind of the poster child of that period. Same thing with AI right now. Not every AI company is going to win. So if you look at particular valuations, you might say, well, this one is kind of high, but not ridiculously high. Goldman Sachs has made that point. But the problem is every single one of them is like that, and not every single one of them can win. And the last thought I'd give you on this is the Sam Altman's, Jeff Bezos has made this comment within the last week as well too, Roger McNamee's. They all say the same thing. Not everybody can win. They're all overvalued, but I'm going to win. Pity the other guy that's going to wind up losing when the bubble comes down. Well, good luck with that kind of thinking. Everybody thinks that, yes, it's overvalued, but not me. Everybody else is overvalued, and we'll have to see how that works out once we go over the top.
Yeah, and take a look at this article that is a good segue here. We have a Harvard economist by the name of Jason Furman who said, according to this article on Fortune, that the U.S. GDP in the first half of 2025 was almost entirely driven by investments in the data centers and information processing technology. Excluding these technology-driven or related categories, the economist calculated in a September 27th post on X that GDP growth would have been just 0.1% on an annualized basis. Now, I'm not here to challenge his math. Let's just assume, for the sake of conversation, he's right. What does that mean? I think that explains, this is just my theory, I think that if that were correct, that explains a lot of the confusion as to why markets are the way they are, with the S&P at all-time highs, with Bitcoin at all-time highs, which we'll talk about, yet the labor market is showing cracks. What do you think?
Yeah, I think that Jason Furman used to be, work in the Obama administration, and his numbers are largely correct, but I would pose it that they're very misleading at the same time. The first quarter, we had a big negative number because of the inventory build around tariffs. So in the second quarter, we had a rebound. So yes, because of that offsetting number, that they look big. Now that I've said that software and information technology equipment has added 1% to GDP over the last 3 quarters. That is the highest level we've ever seen. The only comparable periods to this are the internet adoption in the late 90s, which was a little bit less than the 1% we've seen, and the PC adoption in the early 80s, which was about 0.8, 0.9. So this is something we've seen in the past, that we have this tremendous build. Now, what's different about the AI build is it's stronger and shorter than we've seen before. This gets back to my other comment about AI being, potentially every company's priced as winning. Well, I'll throw out a quick tangent. There's one company that's losing here, and that's Apple. And Apple is losing because they're not playing in the AI space. So the marketplace has said, look, you've got no choice but to play this death match of try to outspend everybody else and win the AI race. If you don't win the race, you're going to be lost. If you don't participate like Apple, you're going to be lost. And so, yes, you're going to see these types of things having a big impact on the state of the economy. You're seeing it on electricity prices moving up because of the tremendous power needs that these companies have had. So yeah, it's somewhat misleading that to say that without it, we wouldn't have any growth, but that's because of the inventory adjustment. And also remember, we've done this in the past. We do have these themes, especially within technology, the internet adoption in the late 90s, PC adoption in the early 80s, where we've seen them have a big pull on GDP. We're seeing that again.
Okay, so ultimately, we know that data centers are driving a lot of the CapEx. We know that tech is driving a lot of the valuations growth of the S&P. What do we do with this concentration bubble that you were talking about earlier?
Well, I think the first thing you need to understand is that everybody's involved with this bubble, whether you want to be or not. To give you an example, Michael Kemblis over at JP Morgan has identified what he calls 45 AI and AI-related stocks in the S&P 500. Since ChatGPT came online November 29, 2022, those 41 stocks have accounted for 71% of the gain in the S&P. The other 459 stocks have accounted for 29% of the gain in the S&P. So if you are an investor in the stock market and you own broad indices, those 41 stocks are 47%, or now 45 to be exact, 45% of the S&P 500. You've got half your investment in this AI space. You are tied in it. Well, I am tied into it. The economy is tied into it. We all cannot really escape it. So that's the first thing I would point out is this isn't just what does it have to do with me? The answer is everything. It has it impacts the economy. It impacts your investments. And so we have to watch where this is going to go and whether or not we're going to get that bubble peak, because we're all going to feel it and we're all going to see it come down on the other side. And again, it's not that any particular company is insanely overvalued. It's that they're all priced at winning. And that's really the message I have, is that they all can't win, but they're all priced as if they are.
Is the market pricing in much lower interest rates? Is that why everything is rallying right now? What's driving the everything rally? I'm talking about stocks, Bitcoin at all-time highs, gold at all-time highs, silver, precious metals. Yeah, anything in particular that's lifting all boats?
Yes, retail investors. Retail investors in the month of September put up $100 billion of investment into the market. That was an all-time high for them to basically plow that much money in. This market is now more retail driven than any market that we have seen in decades. It is not hedge fund driven. It's not institutional investor driven. It is the retail investors at the side. And so they're going in full on into the indices, into AI, and even some of them are even getting nervous about the current situation, and they're going into precious metals like gold and silver. And so you're seeing that tide is lifting all the boats. Now, I'll push back on one thing. The one market that really hasn't been rallying a whole lot has been the bond market, because the yield on the 10-year Treasury is about the same where it was in late April, early May. And here we now are approaching the middle of October, and it hasn't gone anywhere else. And that's maybe because the retail investor is tangentially interested in the bond market. I mean, they're not avoiding it. It's not, yields aren't going up, but it is definitely, that's the big thing, is this constant passive AI bid, constant passive bid from retail investors going into the indices And just to go back to what I was saying earlier, and I don't think a lot of people, yes, I'm buying VOO or I'm buying IVV or SPY. These are the S&P 500 index funds. So I have a well-diversified portfolio. No, 45% of your portfolio is tied to AI is what's happening because of this concentration of the likes we've never seen before.
Take a look at my screen, though. Let's go back to the real economy now. The United States unemployment rate has now risen to 4.3%. It's now the highest since October 2021. This trend has been concerning the Fed. They've made this a reason to start pivoting and cutting rates. Does this trend concern you?
Not yet. And you're right. It is 4.3, the highest since 2021. But in July of last year, it was 4.2. And it's been kind of hovering about 4.1, 4.2, and it, rounded upward in August, the last number we've gotten, to 4.3. Now, we don't have the September number. It's calculated. They just haven't put it out because of the government shutdown. And we don't know. But I think there's a bigger issue at play with the labor market that people are really kind of acknowledging but not appreciating. And what they're acknowledging is the biggest driver of the labor market is the population growth of the country. What drives population growth of the country is net immigration. The border is closed, deportations are up, and this Congressional Budget Office that does these forecasts is saying that we are seeing possibly the lowest population growth in the country in 80 years this year. You have to go back to 1940s, 1950s to find the last time the population grew at 0.1%, 0.1, 0.5%, which is what we're looking at. Why is that important? Because Jay Powell himself said at his September press conference, there's an argument to be made that the break-even rate on payrolls is now 0 to 25,000 jobs, 50,000 jobs, with the midpoint being 25,000. Could be as low as 0. What does that mean? We create one job in the United States, and that's enough. Because we got no population growth, we don't need that many jobs. So people look at 22,000 jobs being created in August, 29,000 over the last 3 months, and they say historically these are awful numbers, and that historically this means the economy is going into recession, except you have an 80-year low in population growth, that the number of jobs you need, according to Jay Powell, is between 0 and 25,000. So the midpoint of that's 0 and 50,000. The midpoint being 25,000. We created 29. That's all we need. This is a different kind of environment because of this low population growth. So what I'm afraid of is we're looking at this data. We're saying historically this is bad. We have to cut rates. But then we say, yes, but there's slow population growth. And I'm like, go to the next step. It should be low, and maybe these numbers are okay. This is what we should expect. But instead, we're trying to stimulate the economy. The last thought I give you is, if we don't have the population growth, we're not going to be churning out 150,000 jobs a month like we used to. And the reason is that there's just not enough bodies to have those jobs if we don't have the population growth. So if we're going to keep stimulating the economy, saying we want to churn out 150,000 jobs, all we're going to do is produce wage inflation and CPI inflation, and that could wind up being bad for the bond market and producing higher interest rates.
Okay. What does this mean for the stock market now? Jamie Dimon, CEO of JP Morgan, said that he's now more concerned or more worried than others regarding a correction. There's a 30% chance of a correction. So if the market is pricing in 10%, I would say it's more like 30%. I'm not saying next year because the timing of these things is almost impossible. He said in an interview with BBC, the level of uncertainty should be higher in most people's minds than what I call normal. I'm not sure where he's getting 30% from, but I'll let you comment on what you think is a probability in your mind that's appropriate, given that we're in perhaps a valuations bubble. We're in a concentration bubble. You talked about the slowdown in the economy. Will this rally continue?
Well, over the short term, I think it will continue, but I think you're right. When you look at valuation, the first thing everybody will say is it's not a timing tool. Okay, it isn't. But what it is an expectations tool. So if you're buying stocks at these valuations, and even if you take out the AI stocks, the market is still fully valued, if you want to use that term, maybe even slightly overvalued. You've got to expect that companies are going to take the high end of Wall Street's estimate on earnings and beat that. Because otherwise, if they don't, they're going to disappoint, and we're going to see a period of underperformance in the stock market. And so that's really where I think the concern is. Where's all the monstrous earnings projections coming from? They're really not out there. Now, I know what the theory is. The theory is that everybody's going to lose their job because they're all going to be replaced by a large language model, and that's going to increase the margins on companies. I understand that argument. It might be true, but it ain't going to be true next year. And it isn't going to be true in 27 or 28. It might be true in 2035, but at least for the near term, it's not. So that's where the problem comes in. So the momentum of all of that constant bid from retail will continue. But as I like to say, hold on to stocks long enough and they might disappoint you because you're buying them and you have to expect monstrous earnings to justify these valuations, or there's going to be a massive disappointment in it.
Retail is also moving into alternative assets like precious metals and Bitcoins. Let's talk about that first. Precious metals first, gold at 4,000, silver at near $50, historic all-time high for both metals. What's driving this rally is the headline question I'm seeing all over the place on mainstream news. And second, what is going to continue, what is going to make this rally continue if it were to continue? I'll let you answer both, Jim.
Yeah, so there's a narrative going around that there's a dollar debasement going on. That's totally false. There is no dollar debasement going on. Because gold is going up, they mean the dollar's being debased? Well, I don't see the dollar falling. I don't see risk markets like stocks and credit falling. I don't see interest rates surging. What I do think you're having happen is the precious metals markets as an asset class are tiny compared to the financial markets. There's probably a cohort of investors, and probably at the retail side, that are worried about valuation, AI, a lot of other things as well too, maybe even some politics in there. And they're looking for safe havens, and they're starting to find their safe havens in either crypto and or precious metal. Well, it doesn't take a lot of money relative to what it would take for stocks and bonds to move those markets higher. So are there nervous people moving into precious metals? Yes. Is that mean we have a dollar debasement? No, I don't see a dollar debasement right now, but that trend could continue with the precious metals moving higher. You saw that with crypto earlier this year. And that has kind of been flattening out. And I think that there is kind of a zero-sum game here between crypto and precious metals. Earlier this year, precious metals were kind of doing nothing. Crypto soared. We got to 120 on Bitcoin. It kind of stalls there, makes a new high by $1,000. Everybody gets excited, and then it doesn't follow through. But now that crypto is not following through, precious metals are moving. I think that bid, they compete with each other for that money. And that's why they kind of take turns going up. But there isn't that broad-based dollar debasement or problem. The stock market's at an all-time high. That is necessarily going to drive a lot more money into that space. Now, maybe that happens in the future. Maybe next week, next month, next quarter, we get the 30% chance that Jamie Dimon's talking about. We get that correction, and you could see, an even bigger bid. But it isn't happening now. And those stocks, crypto and precious metals, are rallying without that dollar debasement.
Right. So let's suppose I were invested in all major asset classes, bonds, stocks, Bitcoin, and precious metals. And I'm thinking, well, I've seen gains in all of these things. Perhaps I could rotate into something else next year in 2026. What would that something else be, Jim, if I were to pursue that course of action? Or perhaps I should just hold onto my current holdings. What do you think?
Well, first, let's start with a basic question. What do you think you should get in terms of your investments? Now, the problem is a lot of people like, 20 or 30% a year, which is completely unrealistic. And the reason they say that is because the stock market's returned them 20 or 30% a year for the last couple of years. A more realistic expectation based on the current valuations in the market, I've referred to it as the 4-5-6 market. Cash should return you around 4%, which is exactly what it's been doing this year, and I think it will. Bonds have been returning you about 5%. Actually, over the last year, they've been closer to 6%, but that 5% is definitely in there. And stocks, given the high valuation, what should you expect stocks to return you over the next, say, 5 to 10 years? About 6%. Now, the problem is when I say 4, 5, 6, getting back to that, I'm owed 20 or 30%, people go, boy, that's terrible. And I'm like, no, actually, it's kind of average. That's what you should have been expecting all along. And you've gotten comfortable with outsized gains in this market. And so if that's what your expectation is, then probably something like the bond market, which would offer you 5% yields with investment grade and give you a fraction of the volatility of the stock market, looks like a compelling investment. If your expectations are no, I think I want more, well, then you're going to be rolling the dice on AI, and you're going to be hoping that the AI trend continues and that you're going to pick somebody, and we're going to still be in the everybody wins category. But when we get to the top on AI, we're going to start discriminating. Somebody's going to win, others are going to lose. You better hope that you have the right company. And if the argument is, how do you get to the everybody's going to win? Buy them all. That's not going to work because it didn't work in the AI. It didn't work in the internet bubble. You own the 3 or 4 companies that won. The rest of them went down 90%. You wound up losing 30 or 40% of your money by the end of the game. And that's really where you got to be careful of with it. So it really starts with, what are your expectations? What do you think you should be getting? I would be arguing to you that 5 or 6%, 4% on cash with no risk is a decent investment to be looking at, especially in an economy that's growing 2 or 3. But the problem is, everybody thinks they're owed a 20 or 30% gain. And that's really where it is. Because when people say, where should I invest? The answer I think I hear them say is, what's going up 30% next year? What's going up 25% next year that I should be buying? Not, should I just take my 5% in the bond market and be happy with it? And I'm saying, actually, you should. That's not a bad investment. It's just that we've become spoiled to more than that.
Psychologically speaking, I'm up a lot this year if I had been holding all throughout the year on all these asset classes that I mentioned. So I'm thinking, okay, well, I want a bit more, right? It hurts me to take profits now and move into a lower yielding asset like a 4 or 5% bond or CD, when I could be getting 50% on gold. You know what I mean? Or even 16% on the S&P, which is what it's up this year, or 23% or 30% on Bitcoin. So I'm thinking, all right, if I just hold on a little bit more, perhaps this FOMO phase is going to get me a bit more gains. But what you're saying is prudent. How do I resolve this internal conflict, Jim?
I think you really got to start to look at, what are your expectations? Let's go back to April. Let's go back to April. There was a lot of people in the week after Liberation Day, when the stock market fell 15%, that were really bothered by it. Were you bothered by it? If you were bothered by that 15% correction in the stock market after Liberation Day, you've got too much risk. You shouldn't be bothered by that. You shouldn't have to say, I have to alter my life because the stock market had a bad week. Because it will. It always does, and it always will. So I think it really comes down to, you've had a good run. I can't answer the question as to how much more risk you want to take. But if the answer is, what do you think the stock market's going to deliver for you over the next several years? I'd say 5% might be a realistic number. I understand, like I said, I understand that people don't like that number, but that actually is not a bad number given the relative valuation numbers that we have. If you should recognize that what you've been in is an outsized period of gains. You've made a lot of money quickly in this market. You don't want to give it back. As I even said, over the near term, I don't see a reason for the stock market to correct over the near term. So at some point, you've got to make a decision on your side. Where do I think I've made enough outsized gains? I'd rather traffic back into normalized gains with less risk. And so that's really the question you have to ask. If it's me, I'd probably be doing it right now. But my risk profile might not match your risk profile. So that's really the question you have to ask yourself.
One thing I'm considering, and some people are considering, is rotating into small caps and in the mid caps. The Russell 2000 has still been underperforming the S&P all year. In fact, it's been underperforming the S&P in the last 5 years, driven, of course, by the Mag 7. The S&P has been outperforming, but perhaps it's time to look into the small caps. What do you think?
Well, they have a more realistic valuation. And one of the reasons you mentioned it, why are they underperforming? Because they have no AI. AI is all mega cap companies right now. And that's what's driving the buzz. Now, if you want to rotate into those companies, you're making a bet that the economy is going to stay okay and the interest rates are going to stay reasonable. And if that's the way you believe about the economy, then that would make more sense. The small cap companies tend to be more economically sensitive than the larger cap companies, because larger cap companies can kind of power through an economy, or they're internationally based, globally based, and one particular economy may not hurt them as much as with other companies. Like, Apple has a big presence in China, but, some small consumer products company in the Russell 2000 has no presence in China. So Apple might be able to survive a downturn in the US, or a small consumer products company in the US is completely dependent on the economy for the US. So if you believe the economy is going to be okay, that might not be a bad place to go. But again, if you were to rotate into those companies, what would you expect out of them? Again, I come back to my 5-6% number. That's largely what they've been delivering. And everybody's been disappointed because it's not the 20% that you've been seeing out of the mega caps because of AI.
All right, Jim, let's finish off on alternative assets. So let's go back to gold and silver. Let's go back to Bitcoin. Let me ask you the question that you asked on X. What's next for silver? You showed a chart with silver historical prices. It's only happened twice in history, and both times of history is any president. Both times, silver did not stay at near 50 for very long. Is that what's going to happen next?
That's a good question, because in both cases it was a big massive spike up in silver, and then a spike back down. It's hard to say, in looking at it, but right now I would think that if I was to bet, I think the precious metals are going to continue to move higher. But here's the problem with the precious metals. They're very speculative right now, more than usual. Buy them, make a lot of money, make a lot of money, make a lot of money, wake up down 20, 25%, lost a lot of money. And that's the risk you're going to face with these things as you go forward in their speculative flows. But if you were to ask me the near-term flow, yeah, I think we're going to take out $50 for the first time in silver's history, and we're probably going to keep moving higher. It's go to 75 or 100. I don't know if I'd go that far that it's going to go there, but it's going to keep moving up. But unfortunately, when you see these kind of parabolic moves, they parabolic in the other way when they go back down, because everybody's sitting on huge profits and everybody's worried they don't want to lose those profits. So when everybody thinks this might be the top, it just doesn't sell off. It goes straight back down. And that's the risk you face with owning something that's very speculative, like silver has become right now.
Okay, a similar question could be asked about Bitcoin. If you zoom out, which I'm going to do, it certainly looks like it's gone parabolic, although if you look at it from a log scale, it's kind of just going up in a 45-degree angle, so nothing parabolic there. I wonder if Bitcoin is just following the NASDAQ still.
I still think it is. But if I was to put a nuance on the crypto space in general, what's happening is there's been a shift back towards ETH. And why has there been a shift back towards ETH? Because the story there is stable coins, DeFi, those types of stories. Bitcoin doesn't have any of that. But ETH does. ETH is the majority of stablecoins, Tether and USDC. ETH does have DeFi. We're talking about, passing the Genius Act, and that we're starting to look at potentially allowing for more payment rails, allowing for more assets, real world assets being put on the blockchain. That's not going to be on the Bitcoin blockchain. It's going to be on another. Now, it might be on the Tron blockchain. It might be on Solana, or it might be on ETH, but it's not going to be on Bitcoin. So what Bitcoin is sitting there looking at is that there's all this hype and promise about exciting things going on in the world of adoption of crypto, but not Bitcoin. Bitcoin will just play the role of store of value, and that's really where it's been going right now, while it's been holding that 120, 115 to 125 range. So I think it's going to continue to do that with Bitcoin. I think that what you're going to see is that adoption. We're going to be talking about stablecoins. We're going to be talking about payment rails. We're going to be talking about real world assets coming on the crypto blockchains. And all of that's going to be everywhere else. And that's why you've seen ETH now year to date outperforming Bitcoin.
The SEC has more or less greenlit the tokenization of securities. So we're going to see more stocks and real world assets, like you said, being put on the blockchain. A lot of discussion around which chains will be used more for tokenizations. There's Solana, there's potentially ETH. Do you have any thoughts there?
Yeah, I mean, I think first of all, it's not the Bitcoin blockchain. They've been pushing back against that. So the big question is really between Solana and between ETH. And it really comes down to a question of, permissionless decentralization. How important is that? Now, for people that are big fans of Sol, I've been skeptical of Sol because I think it's too centralized. And I think because it's too centralized, it can be permissioned. It can be censored. And that defeats the purpose of having crypto assets. Look, the reason we have the blockchain is no one can censor it. No one can alter it. No one can block you from using it. But if we're going to go down that road and allow that, and Circle is talking about blacklisting certain coins, then let's just go the whole way. And let's just run all this stuff in a server at the U.S. Department of Treasury, and then they can pass rules about what we can buy and can't buy, and when we can buy it and can't buy it. You're fat, so you can't buy sugary drinks with your tokenized assets or anything like that. I mean, that's where we'd go with this at that point. Otherwise, if we want to go permissionless and decentralized, then we're going to start screaming that it's terrorism financing and illicit activities and everything else. But then no one can permissionless. So that's the big debate we're going to have. Now, I'm a purist, and I think that the permissionless decentralized is more important than the speed of execution. And so I would lean more towards ETH and less towards Sol. And I know the Sol types will scream at me that they're permissionless and decentralized, but I don't think they are as much as ETH is. And so that's really where the conversation has to go. How much of this do you want outside of the control? Let other third parties like a government or a central bank control this stuff for you. If the answer is none, then you want to be looking at something like ETH. If the answer is some, then, like I said, let's just go the whole way and just let the Federal Reserve run it all off a server and let them decide what we can and can't do with our money.
Jim, excellent. Thank you very much. I will leave on one final question. In 30 seconds or less, maybe sum up what you think will be the best performer for the last quarter into 2026.
At this point, I think, I'll contradict myself in that what's got the momentum? And the momentum is precious metals and AI stocks. So you said the last quarter, that's 2 months to 3 months to 4 months. Yeah. They probably will continue to be the best performers. I hate to say it until they don't. And when they don't, you'll know it at this point. So I don't think that this is going to be a period where we're going to rotate out of into an unloved sector all of a sudden. It's a momentum play, and you want to play the momentum, but it's a high risk play.
Jim, I really appreciate your thoughts. Thank you very much. Where can we follow you, Jim?
X, Twitter at Bianco Research, my YouTube channel at Bianco Research, Jim Bianco on LinkedIn. Those are the three that I usually traffic the most.
All right, LinkedIn, X, and YouTube. We'll put the links down there. Please follow Jim. He's got a great medium for you to learn about macro. And as always, thank you for watching. We'll see you next time. Thank you, Jim.